From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. The Real Yield, Bloomberg, starts right now. Coming up, a soup of data brings conflict to the Federal Reserve, with long-term inflation expectations falling to the lowest level in a year, facing off with the highest current inflation since 1981. We begin with the big issue, recession talk growing louder.
A recession.
Recession.
What type of recession would it be?
If we get a severe recession.
This idea of a hurricane, for example, is probably the wrong idea.
If we get a mild recession.
Probably the right idea is light rain.
The Fed is really in a sticky spot right now.
Right now, they are almost solely focused on the inflation mandate.
And unfortunately, it's a crude channel of, lowering demand.
A stronger Fed reaction, raises recession risks.
The Fed is very keenly aware of that.
The economy is slowing, but the Fed wants it to slow.
You have an overheating economy.
In the soup of recession talk, joining us now to discuss, we are so pleased to say, is Newedge Wealth's Cameron Dawson, Morgan Stanley's Jim Caron, and Lotfi Karoui of Goldman Sachs. I want to start with you, Cameron. As you hear the swell of recession talk, has it become an inevitability?
Well, given the fact that the Fed is still committed to raising rates really rapidly and tightening policy beyond neutral, it does seem that a recession is likely within the next 12 months. Now, it is important that we consider the retail sales data from today or jobs data from last week, that those did come in stronger, but they do tend to be lagging indicators. So it's likely that we start to see deterioration in that kind of data eventually, but it does signal that we're not already in a recession, that the consumer hasn't fallen off a cliff yet. But again, because the Fed is committed to tightening policy as much as it is, it does seem that we have some kind of recession, be it ever shallow, if we do get one.
It seems like a number of Fed members have pushed back in their last gasps of discussion before their quiet period next week. Atlanta Fed President Raphael Bostic suggesting today he is not in favor of 100 basis point a rate hike, saying, quote, moving too dramatically will undermine a lot of the other things working well. We want it to be orderly. Jim, is there too much conviction that the Fed is comfortable with this idea of the inevitability of recession?
I don't think that this is a major risk. I mean, I think it's very, very clear that the Fed understands that they're trying to slow the economy on purpose. I call it a triple D economy, demand destruction by design. This is what the Fed is trying to do. Look, I mean, the Fed's in a difficult spot because some of this is messaging. So when you have a CPI number like we got recently and you have a PPI number on the follow, they have to do something. They have to signal something. So 100 basis points gets put on the table. It's not my base case. I think it's 75 basis points and probably 50 to 75 in September. But this is exactly what the Fed needs to do to at least instill some credibility or confidence that they're on top of this and that they're going to try to effectively rein in inflation risks. So with all of that, then comes the baggage of, that impacts other asset classes even more. And I think this becomes a risk issue for the markets and it creates some volatility. But I don't think that the course of the economy has changed just based on the ramped up rhetoric over the past few days.
There does seem to be a consensus getting baked into the market this week, go into the dollar and go into long bonds. Bank of America's Mark Cabana bringing down his Treasury forecast, writing, quote, we revise U.S. rate forecasts lower following our shift to recession call, now seeing 2.75% on the 10-year in 2022 and 2.5% next year. One important shift in our view is quantitative tightening. Our base case is for the Fed to cease QT with the first rate cut in September of 2023. Lotfi, so much to unpack here, this idea that you can count on the rate hikes and then the subsequent rate cuts as you try to game in recession. Imagine doing the mental gymnastics. Do you agree that the consensus bet of long-dated treasuries going long those securities is the right place to be?
I think the value proposition of duration has definitely improved. If you take 10-year as an example, you've been oscillating around 3%. Our forecast is 3.3, but we're there in terms of the range. Where there's more uncertainty, in my view, is really in terms of the front end. As Jim was saying, 75 basis points seems like a done deal for July. Then it's anywhere between 50 and 75 in September. And then after that, it really depends on that trade-off between growth and inflation. Should that trade-off deteriorate more, I think 2-year will need to converge a little bit further towards the terminal value. Our best view, best guess is that that's around 3.25%, 3.5%. But there's arguably more uncertainty on the front end than the back end of the curve.
Do you agree, Lotfi, that there are going to be rate cuts by next year already?
Not our baseline view. We've raised actually the likelihood of a recession to 50% over a 24-month period, but we continue to see a soft path, a soft landing path here. That path is obviously narrow, but we think that path is still there, and we don't see cuts in 2023. That narrative, of course, reflects the view that by 2023, a recession will become a reality, and the Fed will be forced to operate a pivot in the dovish direction.
Well, and Jim, what's your view on that? Because that's been basically one reason why some people are actually bullish on certain risk assets, that this is going to be a shallow recession that's going to be met with the same stimulus that this market has always enjoyed in the face of trouble. Do you agree?
So I don't agree with the view that we're going to have a soft landing. I think that we're going to have a hard landing, possibly a recession. We may be in a technical recession already. But that being said, a lot of this is already in the price. So what's very, very interesting right now is that the Fed is telling us they're going to 3.5%. But bond yields are refusing to move to those levels. And I think what's interesting there is that if we roll the clock forward 6 months forward, let's say when the Fed is at 3.5% or possibly even higher than 3.5%, then that means we're going to have a deeply inverted yield curve. And what we're seeing is an inversion of the curve that's led primarily by the 2 to 10 year segment of the curve, which is telling us something about the economic slowdown ahead. But anything that's attached to the back end, out to 30 years, 20 years in particular, is telling us that the market's baking in a higher inflation risk premium. So the two things that are being communicated is that, yes, we're going to have a slowdown. No, we're not going to fully control inflation. So effectively, you get a slower economy, but inflation falling, but not falling enough. And that becomes the stagflation fears that people get worried about. So I think it becomes very interesting on the curve. If the Fed goes to 3.5%, but yet 10-year Treasury yields can't get above 3%, that communicates something very, very different to me.
Well, and especially because right now we're seeing the deepest curve inversion of that specific one that goes back to 2000. So what kind of message is that sending? Before I get to you, Caron, on this exact point, I'd love to get your view, Jim, on what that implies for what's getting mispriced elsewhere in risk assets.
So I think what's getting mispriced at this point is that people are looking at long-term interest rates at this point in the market, and they're not putting in enough inflation risk premium that's there. Even if we look at 30-year long bonds around 3%, to have a 30-year long bond around 3% when the Fed is going to hike rates very, very likely to 3.5% or even higher than that, what you're saying is that we're going to have a really, really deep decline. I don't think that's what we're going to have. I think I'm in the camp that we still have a mild recession. But what it also says is that there should be higher yields in the back end. In other words, the curve should steepen out in the 20 and 30-year points. That's where all the inflation risk premium should come in, which then suggests to me that when you discount your cash flows in the very, very long term, that many assets, this could be equity, this could be credit, this could be many other things, probably aren't building in enough risk premium. So they're still vulnerable to moving lower and cheapening in this environment, because I don't think people have really truly accounted for the possibility that we still have lingering higher above target inflation for a longer period of time, as opposed to inflation coming back to target, which is what the Fed is telling us.
Right.
I think we can get to target, but I don't think we stay there. I think we bounce off it and we stay higher than that.
Caron, what's your view on this, especially as people, frankly, take the other side of this and start going into long-dated bonds and really treat risk assets, high-yield debt in particular, with a pretty sanguine brush relative to some of the pain in equities?
Yeah, if we look at the long yields to start with, the bond market clearly believes that the Fed is going to be successful at controlling inflation. And we can see that with long-term inflation expectations from a market basis. They've gone from 2.6% earlier this year down to 2.1% today, which is just about in line with the Fed's 2% target. So clearly the bond market still thinks that this is a cyclical inflation episode and not a secular one. Now, on the question of high yield, we've been trimming back high yield exposure into the recent rally with the notion that as long as the Fed continues to deliver on this policy tightening, it should be a headwind for high yield as liquidity gets removed from the system. So people have been stepping into this market, looking kind of at those juicy rates that, as we've seen spreads go from about 350 basis points to 550 today. But we think that there's more spread widening to come in high yield, mostly with a Fed that has less options to come in and bail out those profligate borrowers, to bail out the market like it did in 2020, just because of inflation remaining so high. It boxes them in a corner to not be able to provide the same kind of liquidity that they did in prior high yield sell-off episodes when inflation was really benign.
Well, which raises a question about liquidity events. And this is something that Michael Shaul was saying on Bloomberg Surveillance earlier this week. Lotfi, I'd love you to weigh in on this. Are we careening towards some sort of liquidity issue or some sort of fissure in the market functioning as people reset their expectations for credit? I mean, we've been dealing with people saying people have priced in and basically dated out their maturities so long it won't matter.
I mean, so far I would describe liquidity conditions and more generally the state of the market microstructure and credit as strained, but not stressed, and certainly not nearly close to the levels of stress that we had in the first quarter of 2020, and hopefully we won't be there. But yeah, that is definitely the number one risk that we've been focused on here. Whatever structural vulnerabilities we had in terms of secondary market liquidity conditions pre-pandemic, those vulnerabilities are not gone. They may have been masked by the significant amount of excess liquidity that easy monetary policy has pumped into the system, but they're not gone. And so one of our key messages in terms of relative value has been not only up in quality, but also up in liquidity too.
Everyone is going to stick with us. Camry Dawson, Jim Caron, and Lotfi Karoui. We've got a lot up next, including the auction block. Corporate debt sales stalling once again with another inflation print, keeping issuers at home. We'll talk about that. And we'll also talk about what's going on in Europe. This is Bloomberg. I'm Lisa Abramowitz in for Jonathan Ferro. This is Bloomberg Real Yield. Time now for the auction block, where we kick things off in Europe with corporate bond issuance set for the slowest July on record. Sales from the region's non-financial firms falling short of 2 billion euros. In the United States, high-grade debt issuance remaining limited yet again, missing weekly estimates despite PepsiCo's $2.5 billion bond sale on Thursday, and Cornerstone marketing debt to fund its buyout by CD&R. Just the second high-yield bond sale of July. Sticking with credit and the lack of issuance, BlackRock's Rick Reeder started to actually put some work into cash.
The credit markets, we started to let the line out a little bit on some of that cash. You think about if we're going to be run rate inflation over the next 5 to 10 years, if you could buy high yield at 9.5, you could buy investment grade quality in the front to the medium part of the yield curve at 5-ish. Boy, that's a pretty good real rate. There's some stuff to do now.
So some people might be getting a little more optimistic, others still staying away. Cameron Dawson, Jim Caron, and Lotfi Karoui still with us. We did talk about this earlier. Citigroup even lowering its corporate bond sales forecast by 11%, with an analyst writing, quote, "We revised down our gross issuance forecast to the bottom quartile of the predicted range at $1.2 trillion, contingent on more stable secondary market conditions toward year end, preventing a lockup of the IG primary market." I want to start with you, Lotfi. How much do you see this slowdown in the corporate debt issuance market as simply companies not needing to borrow and deciding not to lock in rates that are not conducive to their business versus not able to access financing at all?
I mean, it's always an interesting debate. Does this reflect the unwillingness of companies to go to the primary market, or does it reflect the inability to do so? We would lean towards the former explanation, that this is by and large a normal response to higher funding costs, elevated volatility, and really the unwillingness of companies to go to the primary market just because you don't need it. Keep in mind that we had two back-to-back record high years, 2020 and 2021, in terms of new issue volumes. the bulk of the proceeds from the debt that was raised back then is actually still sitting in the form of excess liquidity on balance sheets. Companies have done a very good job terminating out maturities. And so you look at the maturity wall, there's very little to refinance in the near term. And I think the second half of the year will play out exactly like the first half of the year. Until you get full clarity on where we're going in the cycle, I do think that primary market activity is going to remain fairly muted, which is, by the way, has been an incredible source of support to the secondary market because it's provided a very meaningful offset to the weak demand technicals that we're seeing.
So when does this become a problem, Cameron, for the Fed, for others who start to see this as a breakdown in the functioning of capital markets if companies no longer have access to capital?
Yeah, I mean, that is the thing that could certainly get the Fed to pivot, but we're not at a point of strained liquidity yet that is anywhere near the prior Fed pivots. If we just look at high yield spreads, at 570 today, they peaked at over 800 in 2016, 1100 in 2020. That certainly got the Fed to move to become supportive. And the Fed has told us that they want to see financial conditions tighten. That's been an express purpose of this tightening cycle, and credit spreads are part of financial conditions, as are equity valuations, as are interest rates, as well as the dollar. And so though we've seen the fastest tightening of financial conditions on record during a tightening cycle, we're still on an absolute basis, still relatively well contained. It really speaks to the starting point where we were in this tightening cycle, where we were starting from such incredibly loose and accommodative types of policy. And so, yes, we've seen rapid tightening, but we're not at the point yet that supports a Fed pivot.
Well, and Jim, this really raises a question of when it becomes an issue for the functioning of markets. We were talking about that earlier, but I keep coming back to that. Is this by choice that there isn't as much issuance, or is it by just simply the scenario where companies can't raise financing? How do you draw that distinction?
Yeah, I think as Lotfi was saying, the companies just don't need to raise as much right now. We had two back-to-back years of record issuance. And effectively what this does is, this is one of the reasons why we think that it's likely that we have a more mild recession, because there's no liquidity strain that's apparent at this point. Many corporations have already funded themselves. So even if interest rates rise in the very, very front end, it's not like they're short funding themselves, and this is creating stress in the markets. So I think this is all very, very positive at this point. I mean, clearly prices are readjusting to the risk of a slowdown and slowing recession. But what we also have to remember is that the reverse repo facility at the Fed is over $2 trillion. This is a lot of excess liquidity that's trapped effectively in the system right now that's really geared towards high quality, liquid, short dated assets. And every time rates start to pop up a little bit, these assets get bought very, very aggressively. So we are coming from a technical strong point. Where I think we ought to look in terms of where we may find some stress, I would start to think about the emerging markets a little bit. The reason is that the dollar is getting very strong. Commodity prices are coming off, but yet interest rates, the Fed continues to hike interest rates. Those three things create some issues, and you could start to see some relative funding issues maybe in those markets. But as far as the domestic U.S. market, from a liquidity standpoint, I don't really see this as a primary risk. And even in the emerging market space, let me be fair. It's not the primary risk at this point either. It's just something to watch out for as we get a global slowdown in growth, and if commodity prices, continue to move lower and interest rates move higher, this could create some dollar funding pressures.
Jim, Caron, Dawson, Lotfi Karoui, you're all sticking with us. Still ahead, the final spread the week ahead, featuring a host of U.S. housing data and an ECB rate decision. That conversation coming up next. This is Bloomberg. I'm Lisa Abramowitz in for Jonathan Ferro. This is Bloomberg Real Yield. Time now for the final spread the week ahead. Coming up, big bank earnings continuing on Monday, followed by a host of U.S. housing data throughout the week. We get Eurozone CPI on Tuesday, consumer confidence Wednesday, And finally, a busy Thursday featuring the Bank of Japan and an ECB rate decision. Still with us, Cameron, Dawson, Jim Caron, and Lotfi Karoui. The ECB decision may be one of the most interesting decisions that we have seen in a long time. Lotfi, how much can they address the push-pull of inflation that's accelerating and also a splintering European region?
I mean, look, this situation is quite challenging in Europe, certainly more challenging than in the US, but you're facing an energy crisis, you have elevated inflation, and then you have questions over the debt sustainability of the likes of Italy and the periphery. And so that is an incredibly difficult equation for the ECB to solve. What do we think they'll do likely? I think in the near term, they'll look through some of the supply issues in the gas market here and proceed basically with a liftoff in July. After that, we think they'll go with 50 basis points in September. At the same time, we, like many others, do expect them to announce some kind of a backstop facility to deal with what the ECB has been calling fragmentation risk. That's something that is meant to essentially put a ceiling on how wide spreads, BTP spreads can go. After that, it does get more complicated. We'll learn a lot between now and September. Any sort of further deterioration in that growth inflation trade-off will likely cause the ECB to slow down the pace of the normalization of policy, possibly push the terminal value of rates lower. But between now and September, I think we'll learn a lot.
All right, this is time for my favorite part of this program, the rapid fire round. And I want to give some time to this. And I'll give you some time to think about it as I read it as slowly as I possibly can. The number one is, do you think the Fed will start cutting rates next year? Cameron?
Yes.
Jim?
Yes.
Lotfi?
Oh.
Number two, what's a worse trade right now, buying emerging markets debt or European bonds? Cameron?
Emerging market debt.
Jim?
European bonds, a lot's in the price for EM already.
Lotfi?
EM debt.
Okay, and number three is, are U.S. investment-grade corporate bonds a buy or a sell? Cameron?
Buy.
Jim?
Buy.
Lotfi?
Buy.
All right, so 3 for 3 there at the end. My thanks to all of you, Cameron Dawson, Jim Caron, and Lotfi Karoui. It did seem like this week in bonds, there was one consensus trade, and it was to go long duration, long bonds. You saw a huge rally and retracement as the dollar surged. For next week, we shall see if that holds as the ECB tries to respond to their region. And frankly, as people take a look at the prospect of inflation, we will also take a look at the risk appetite as we take a look at some of these underlying measures of the consumer. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.